Welcome to PNJ Training. In this section of our Mastering ASC 326 series, we cover CECL accounting mechanics, focusing on journal entries and financial statement presentation. By the end of this lesson, you will know exactly how to record every major credit loss event, how the allowance appears across all three financial statements, and what disclosures a SC 326 requires in the footnotes. Before we look at individual journal entries, it helps to see the full CECL lifecycle in one view. There are 4 stages. First, initial recognition, where you establish the day 1 allowance. Second, subsequent measurement, where you adjust the allowance up or down as credit quality changes. Third, write-off, where you remove an uncollectible receivable from the books. Fourth, recovery, where you reinstate and collect a previously written-off amount. Each stage has its own journal entry pattern, and we will walk through all of them. At day 1, the moment a financial asset is first recognized, you immediately record the expected credit loss. The entry is debit credit loss expense, credit allowance for credit losses. There is no waiting period. There is no grace period for overdue status. The loss estimate hits the income statement on day 0, and the contra-asset allowance is established on the balance sheet at the same time. This is one of the most significant behavioral changes CECL introduced compared to the old incurred loss model. After initial recognition, every subsequent reporting period you reassess the allowance. If credit quality deteriorates or the portfolio has grown, the current allowance is too low. You record an additional debit to credit loss expense and a credit to the allowance for credit losses to increase it. If credit quality improves or the portfolio has shrunk, the allowance is too large. You reverse the excess with a debit to the allowance and a credit to credit loss expense, which is now a benefit. The key point is that both the expense and the benefit flow through the same income statement line item. When a receivable becomes uncollectible, you write it off. The entry is debit allowance for credit losses, credit accounts, or loans receivable. Notice what is missing here. There is no P&L impact at the point of write-off. The loss was already recognized when the allowance was established or increased in a prior period. All a write-off does is remove 2 equal and offsetting amounts from the balance sheet. The gross asset goes down, and the allowance goes down by the same amount. Net carrying value does not change, and the income statement is untouched. When a previously written-off amount is recovered, you need 2 separate journal entries. Step 1, reinstate the receivable, debit accounts receivable, credit allowance for credit losses. This brings the asset back onto the books and restores the allowance. Step 2, collect the cash, debit cash, credit accounts receivable. The 2-step approach keeps the audit trail clean. After step 1, the allowance is slightly higher than before the recovery, so it is ready for the next subsequent period assessment. 2 special scenarios bypass the normal day 1 P&L hit. First, purchased credit deteriorated assets, or PCD assets. When you acquire a financial asset that already has credit deterioration, you use the gross-up approach. You add the expected credit loss allowance directly to the purchase price when recording the asset. The entry is debit loans receivable for the purchase price plus the allowance, credit cash for the purchase price paid, and credit allowance for credit losses for the allowance amount. There is no day 1 credit loss expense. Second, the CECL adoption transition entry bypasses the income statement entirely. The cumulative catch-up goes directly to retained earnings, with any tax benefit recorded as a deferred tax asset. Prior periods are not restated. Off-balance sheet credit exposures, such as unfunded loan commitments, require their own entry. The credit does not go to the allowance for credit losses contra-asset. Instead, you debit credit loss expense and credit a separate liability for off-balance sheet credit losses. This liability sits in other liabilities or accrued liabilities on the balance sheet. It is not netted against any asset because the funded asset does not yet exist. This distinction matters both for balance sheet classification and for disclosure. Now let us see how all of this appears in the financial statements. On the balance sheet, Financial assets at amortized cost are shown at gross amortized cost less the allowance for credit losses, giving you the net carrying amount. You must present the gross balance and the allowance separately, or disclose the split in the notes. On the income statement, credit loss expense is a distinct line item. Interest income is recognized on the gross amortized cost, not reduced by the allowance. On the cash flow statement under the indirect method, credit loss expense is a non-cash item, so you add it back in the operating section. Write-offs have zero cash flow impact. Recoveries are operating inflows. One of the most important required disclosures is the allowance roll forward. It shows, by portfolio segment, how the allowance balance moved during the period. The formula is straightforward. Opening balance plus credit loss expense minus write-offs plus recoveries equals closing balance. This roll forward must be disaggregated and presented separately for each portfolio segment, giving financial statement users a clear picture of where credit risk is concentrated and how the reserve is changing over time. Beyond the roll forward, a SC 326 requires several other footnote disclosures. Your accounting policy note must describe the estimation method, pooling approach, write-off and recovery policies, and your forecast horizon and reversion method. You must provide an aging analysis of outstanding balances by aging category and class of receivable. Credit quality indicators are required, showing amortized cost disaggregated by credit quality grade. For financing receivables, you need vintage disclosure, amortized cost by credit quality and origination year. This is not required for trade receivables using the loss rate method. You must also disclose significant assumptions and Q-factor descriptions, any concentration of credit risk by industry, geography, or major customer, and the nature, methodology, and liability balance for off-balance sheet exposures. Taken together, these disclosures give users full visibility into how your company measures and manages credit risk. Thanks for watching. If you found this useful, subscribe to PNJ Training for more videos like this. Thank you for watching. Subscribe for more training from PNJ Group.